The IMF released its updated forecast for GDP for the years ahead. What was notable, of course, was the downgrade in growth forecasts for 2015 and 2016. What I'm looking at here is the progression of growth over the past 5 or 6 years, and also I highlight the projections that have been made. Now, I want to first turn your attention to the grey line here. This is the actual number, so going back to 2010, you can see that the 2015 projection, that's what that is, although we're 9 or 10 months through the 2015 period, they have lowered the growth rate to 3.1. The dotted line above it shows where they were in April when they did their first forecast. For the year ahead, they're looking at growth of 3.6. Back in April, they were looking at 3.8. So you can see a couple of observations. One, it's a recurrence of the downward revisions from April to October, which I'll go through in a little bit more detail shortly, but also the growth rate to be experienced this year is going to be the lowest in the post-GFC recovery period. As you can see, this pattern of downward projections has been a fairly consistent one. If we go back to 2012, and I'm going to look at, I'm only for each year, each forecast, I'm looking at the April forecast and the October forecast for the year ahead. So back in 2012, the IMS was forecasting GDP of around about 4.1 in the following year. It ended up being about 3.6. The gold line there is 2013. The initial projection was 4% for 2014. It came in at 3. They lowered it to 3.6 by October. For the 2015 growth rate, the initial forecast was around about 3.8, come down to 3.7, and we can see again the forecasts have been downgraded. So this has been a very consistent pattern. I guess what the different observation to make here is that, as I mentioned, this is the lowest outcome, or likely to be the lowest outcome in this whole post-GFC recovery period. IMF and most market participants continue to forecast an eventual upturn in growth, which has continued to disappoint. One of the other ways of looking at it, if we look at IMF growth rates, these are GDP recoveries, global GDP recoveries since 82, 91, 01 and 09. They're the big last four recessions. So the black line is the most recent observation. So this is the trough, if you like. They're the recession troughs. The black line shows the path of GDP in the period since. This last number, as you can see here, for the 09 coming up there to 3%. If we compare that to previous recoveries, I guess the observation can be made that it's been on average about 0.5 to 0.75% below the typical recovery that we saw in the previous three recoveries from recessions. But also, I guess somewhat more concerning is by about this time, about sort of 8 to 10 years into a recovery, typically we've seen quite a more significant downturn. Yet at the moment, the IMF and other forecasters are projecting an imminent upturn in GDP growth. If we look at industrial production, growth. The chart here shows 6-month annualized change in global industrial production. You can see that it fell down to around very close to zero, and in fact, at the lowest level in this, once again, in this post-GFC recovery period, and indeed it's sort of in line with the lowest levels outside of the last two recessions of 08, 09 and also 01, 02. So quite a worrying trend had developed in global industrial production. What is also noticeable is that we've had a slight uptick in the last month or so, which is providing at least some comfort that the global cycle is not continuing to turn down. Where has that come from? Well, if we break it down into the individual components, we'll look at, say, emerging markets or emerging economies. We can see the 6-month annualized growth rate, a lot more volatile, but it has picked up. That's actually 3 months. Let's make that 6-month annualized. You can see there, that's the emerging market 6-month annualized growth rate has picked up as well. That has come out of Asia, but it's still at very low levels, as you can see there. And for advanced economies, if we use the 6-month annualized growth rate, that's the gold, that's trailing at quite weak levels. And I think the US has been a bit of a driver of that weaker growth in recent times. Well, what are some of the leading indicators telling us about the trend in global industrial production? We can look at ISM's, IFO type indicators or broader measures of G3 momentum. I want to look at, initially we'll look at, say, the US manufacturing index, and that has, as we know, has fallen away in recent times. That's the red line. Most recent couple of months, it's fallen away quite sharply. So that doesn't augur well for global industrial production if we look at that relationship over the longer term. Likewise, if we use the Chinese PMI, that too has also fallen to new lows in this post GFC recovery phase. The German numbers have actually been slightly better. European numbers have been slightly better. If I use the IFO as an indicator for Germany, we can see that they've kicked up over the last 6 to 9 months, and after a bit of a scare, sort of held reasonable levels. If we try and combine all those indicators into a more of a measure of growth momentum across the big four regions or economies, we can see there the relationship between industrial production, which is the blue, and G4 momentum. So that was starting to turn up, but the most recent US numbers and in fact Chinese numbers have turned that down again. So it's suggesting that it's going to, and it's below zero. So below zero and flat to down suggests that this global IP number is going to struggle to make any sort of recovery in the very near term. What about what it means for equity markets versus bond markets or asset allocation type decisions? So what we're looking at here now is the relationship between that G4 growth momentum index that we were looking at and global equity returns relative to bond returns over a 6-month period, that being the red line, and that's on the left-hand scale. So they've underperformed bonds. This is long bonds by about 8 to 10% over the past 6 months. The blue line is that G4 momentum. What it suggests, obviously it's a much more volatile series than the growth momentum indicator, but it is suggesting that the market is perhaps pricing in already pricing in a further deterioration in G4 momentum or global growth from where it currently sits. So if we have a look at a distribution of returns under different economic conditions, and now I'm still using the G4 growth momentum series, if I look at periods where that's above average and rising over a 3-month period, and then we're looking at equity returns versus bond returns in local currency terms over 3-month periods, you can see that when that's true, when that condition is true, the excess returns of equities over bonds has been about 5.4% on a quarterly basis. It's been positive 80, almost 82% of the time, versus in all other periods, equities have underperformed bonds by 3.25% and done so about half the time. There's the distribution of returns. Excess returns of equities being red when growth momentum is above average and rising. We could look at some other and we're certainly not in that phase at the moment. We're a fair way below, we're well below average and in fact declining. So what's actually happened during those periods? If we look at below average and falling over a 3-month period, we can see that the average underperformance has been almost 5%, and it's been negative, i.e. equities have underperformed bonds about 2/3 of the time, and they're the distributions, the red being this particular condition. So it is very much down to what happens to growth momentum, we think, in the near term. It would suggest to us that near term the risks are probably still a little bit to the downside. We would need to see some shift in US and Chinese growth momentum in particular, because they've been two of the key factors pushing growth momentum down over the past few months.